Welcome back up, Jeremy Szafron. The United States struck Iran again overnight. Oil flows through Hormuz remain disrupted, although tanker shuttling is helping more barrels escape. Yet, take a look at this screen. Crude lower. Brent is down more than 1.5%, and then refined products are falling harder still, with gasoline down nearly 2.5%, heating oil down a full 3%. Now, that is not the reaction you'd expect when a Middle East conflict is escalating, and it's part of a mixed set of signals this morning. The economy grew more slowly than expected last quarter, but consumers spent more than forecasted. Inflation cooled month over month, and yet the 30-year Treasury yield is sitting near a 19-year high. Also, stocks rebounding hard today after getting hammered yesterday. And gold also moved back above $4,100 on the spot side. Now, my next guest looks at all of that and reaches consensus well outside the Wall Street consensus. He thinks that oil is headed sharply lower, war or no war. He thinks that the Federal Reserve's next move is down, not up. And he also thinks that gold's high for this cycle is already behind us. He did call the $5,000 gold call before it got there. Then he turned around, called the top. He was right on timing. So obviously it's worth hearing how he gets there now. Stick with us. We'll get into it. Mike McGlone is senior commodity strategist at Bloomberg Intelligence. Mike, a lot to unpack this morning. Always good to have you back.
It's great to be back, and thanks for having me back, Jeremy, because you become my go-to. When I'm looking for information and stuff, I go to you and listen to a lot of your interviews, and so I appreciate that.
No, I appreciate that. And you know, a lot of people, as we mentioned, were, not happy about your top of the market call on past 5,000 on gold. We aired it. You were correct on that. And I kind of wanted to start with the Fed today before we get to the metals, because, it's interesting. And right after that Fed meeting yesterday, you kind of wrote, because your view sits well outside that current consensus, as I mentioned, that the Fed held. Obviously, 3 officials wanted a hike. The market's now assigning a greater risk to a September hike. And your read was, quoting you, much ado about nothing. Now, you said that the next move may be a series of 50 basis point cuts, and that the Fed will be following the stock market on the way down. Make the case. Why is the next move lower, and why is it, half point steps?
Well, I had to put that out partly because we're both in the media, and I like to say, as a research strategist, I can write the best research on the planet. But if I don't write out provocative headlines and catchy headlines, I don't get readers. It doesn't matter. I'm out of a job. So we have to sometimes. That's what you do. You have to sometimes accentuate things. And this whole Fed is much ado about nothing. There's not going to tighten. I think the next move from the Fed will be a series of 50 basis point cuts and a normal reversion cycle in the stock market, which means a recession. But that's all that matters. Otherwise, there's no reason for them to do anything. They can't really hike rates. For Mr. Warsh to hike rates would be a complete profile and courage, which I think is very unlikely. Now, it could happen, particularly as his term moves past Mr. Trump. All we care about right now is what happens in the second half of the year. It's so profound. But the bottom line, from inflation's elevated, and the key thing, I think the market's going to look back from the future and say, duh, that was dumb. For the Fed to be cutting rates in an environment with stock market running 2 times GDP, and this is the last few years, and inflation above their target, and bond yields going up and telling them not to cut rates, so just going to look back in the future and said, yeah, we're not going to do that again. And I think Warsh is saying it, but he's not really doing anything. And I think the simplest thing for the Warsh to understand, and I think him and Besson get, really, they're ex-traders, is 'tis the season for volatility to pick up. It's end of July. Only thing you got, when at the end of May, you got to look forward. You have to look forward to the summer and the moribund season. Now we're looking forward to the fall, which might mean a fall in prices in certain things like a stock market. And we have indications. I look at things like the Kospi, it was up 110% on the year. Now it's up 30%. We've had pumps and dumps in versus all the metals, gold, silver, platinum, palladium, and Bitcoin. And they're hovering down. To me, the signals I'm seeing from markets, also with volatility in the stock market running their multi-decade lows versus the volatility you see in gold and crude oil and things like that. Just a little bit of reversion in that, I think, is what we have to look forward to. I think the Fed gets it, and I think they understand it's all they need is a little backup in the stock market. Poof, everything's fine. Inflation will be alleviated. All that excessive spending and the wealth effect will be removed, and then they can think about easing. But right now, to hike, good luck. That's not going to happen. But if inflation stays sticky, they might have to. And here's the key thing that's changed, Jeremy. This is how the world has changed, how the answers have changed. And that is, in the past, for president would pressure the Fed to ease rates to boost the economy, help them get elected. Now, what that does is create more inflation. It's the number one issue in the elections. Midterms are coming up, and inflation means incumbents are not getting elected.
Yeah, yeah. And you did connect that kind of the Cosby correction, gold, Bitcoin is kind of part of the same unwind. And the line that obviously stuck with me was following the stock market. That means the Fed is taking, well, I guess it isn't leading here, it's reacting. So what kind of has to happen first? Is it another 10% off equities? Is it 20, or is it credit rather than the index that forces their hand?
Oh, it's always there's always peripheral things. But right now, the bottom line, the most significant 10 on its scale on a 100-year basis, on a global basis, for all normal post-inflation deflation is the U.S. stock market. And we've already seen peaks in housing many places. I have a good friend in Florida real estate for decades, and his quote was, "If I could short Florida real estate, I would." And this is
Yeah.
someone who bought a condo on credit in 2020. It's just the way the cycles work. We're seeing it in consumer sentiment and inflation and things like like this. I might like diesel and gasoline prices near multi-decade highs, and that's hurting consumers. But the bottom line is, it's all that matters now. Everything is dependent on the stock market. What's driving consumer spending? And the 20% of the top 20% of income producers and income people in this country are doing quite well, but the rest of the economy is not doing so well. 55% of our citizens are wage earners. They're not doing so great, and the rich people are doing better. But to me, that's the whole cycle. But the signals from markets are so profound, Jeremy. I mean, sometimes you just can't. When you can say that gold is at a 4-decade high versus a basket U.S. Treasuries, look, that's kind of significant. When you can say gold 60-day volatility just reached the highest ever in
Yeah.
the history of gold trading, with the stock market going up, that's a bit of a problem. And you can say things like gold's volatility, annual volatility, is trading at a multi-decade high, almost a 20-year high versus the stock market. That's a bit of a signal. And I just look through the second half of this year, stuff that I've been wrong on forever, that we're going to have a backup in the stock market, might kick in. And here's what I look at. If we have just a ho-hum year and stock market keeps advancing, saying S&P 500 is up 10% or so in the year right now, and adds another 5%, it's nothing. It's not a big trade. But if it starts dropping for a normal midterm year, the last two midterm years, 2018 and 2022, were the only years since 2008 the S&P 500 total return was down. And if it drops for a normal cycle like that, the dominoes kick in. And that's the key thing, Mike. I'll end with this. I was at a panel. I was moderating a panel at the Global Alts Conference in New York. I think that was in June. And the guy next to me was quite bullish copper. I get everybody's bullish copper. I get there's a good reason to be bullish copper. But everybody says the same thing. And I said, well, you bullish the stock market? And he looks like my three heads. Well, if you're bullish copper, the stock market absolutely has to go up. If history is a guide, because if stocks drop 10%, copper's dropping 20 or 30%, based on just normal correlations. Metals are highly correlated to stocks right now.
Mhm. Now, we're talking about inflation as well, and I kind of want to put both sides of this to you, because the data seems like it's genuinely split. I mean, your side first, the core inflation rose just over 0.1% in June, according to the Commerce Department, the mildest month since March of last year. And if that 1 month pace were kind of sustained, it would annualize to about 1.6%, below the Fed's target. But then look further back in the same report. I mean, the 6 month pace is running 3.8%, and that's worse than it was a year ago. The 12-month is 3.3. So the latest month says inflation momentum cooled sharply, but the longer trend says that the problem is still there. I mean, which one is the signal? Which one is the noise?
Oh, there's so much noise. And this is where I think I keep further backing off from the market a little bit, looking at a top-down view. Inflation simplistically has probably peaked. I'm going to put that in my headline for my August outlook for commodities. I think inflation's peaked at 4.2%. That's CPI. I think crude oil's peaked at 120. And the key thing I have in the headline for next year, I fully expect CPI can easily get to 0%, and crude oil can get to near 40 on a normal cycle. There's one key prerequisite for that, just to say a 20% drop in S&P 500 that stays down, or even a 10% drop from here now. That's the way things usually work. We're so overdue for a post-inflation deflation cycle. And he could think of what's happened with crude oil and CPI. They both kind of peaked from lower highs, lower plateaus since the peak in 2008. Now, inflation obviously had a little run when Russia invaded Ukraine, and they've made lower lows since. Has that trend stopped? But that's also happened with stock market cap to GDP reaching the highest on a year-end basis since 1928, and most significantly, stock market cap to public debt reaching 1x or so. That's the highest since 2007. That's part of the reason bond yields are the highest since 2007, which is a major pressure for all non-income producing assets and commodities, most notably precious metals.
Yeah, I want to talk to you about the bond market. Before we do that, can you stick on oil there? Because obviously that call on
Sure.
oil, the timing is what stands out. I mean, as I mentioned overnight, obviously the U.S. hit dozens of Iranian military targets. Iran strikes reached Jordan and Kuwait. I think drones also struck two natural gas vessels in an Egyptian port. Now, oil flows through Hormuz remain below pre-war levels, but tanker shuttling has picked up and bypass pipelines are moving more barrels out of the Gulf than ever before. I mean, you just talked a little bit about Brent with West Texas in the low 80s. You know, you're talking about the risk into year end is kind of energy and deflation. Just get into that a little bit much more here, because I mean, much of the market is positioned for an oil, or I guess we could call it a supply shock. I mean, you're calling for that. Take me through it.
Well, this is what I really enjoy learning from many people like you and some of my colleagues on my energy desk who dig into the weeds of the energy market. I look on the top down, there's a 10 on a 1 to 10 scale in energy market. That's one of the most significant 10s I've ever seen. Is what is the motivation of the world's most of the leader of the world's most significant energy producer and a net exporter, not just of energy, of corn, soybeans, wheat, grains, liquid fuels, biofuels, into the midterms. The person who actually initiated this war in Iran. Iran is becoming, OPEC was becoming redundant before this war. The price-making status in energy has shifted over to the Western Hemisphere. The U.S. in the middle, Canada to Argentina is becoming a bit of a drill at will. And they just had the best incentive since the Russians' invasion of Ukraine to sell and produce at a profit. Yes, we're in a bit of a nuances right now, but there's a reason, as we speak right now, the price of WTI crude oil is $84 a barrel. That was first traded in 2007. Now we have things like distillates, diesel, and gasoline running their multi-decade highs. That's a big problem. Mr. Trump absolutely has to get those down by midterms. And if he says he doesn't care, he cares. I just love that nuance, having followed politicians for decades. But that's the 10. Now, how he figures that out, I don't know. This quagmire of a war that was supposed to be done in 2 weeks with unconditional surrender, which I'm sure is what he was speaking, that's his problem. He'll figure it out. But the bottom line is he needs lower energy prices. And the key thing to always remember about energy, it's one of the most autocorrelated sectors of commodities. It's also what I like to point out is the key thing people miss sometimes, and they really accelerated in 2022, is that that force of autocorrelation in commodities is one of the most significant incremental increase in force in commodities. We proved that. Rapidly advancing technology and demographics. When you get a pump in price, you incentivize more supply, cut the demand, prices go back down. Why is the price of soybeans we see in the screen right now the same as first traded in 1973? That's $12.90, because we can produce more with less every day. So that's my macro for commodities. So I'm and for crude oil, I'll put numbers on it. Right down at $84 a barrel. I think the high for the year, I called it earlier, is 120. We could get near there, but imagine if we do, with that would just, would be its own worst enemy, and then would just be down later. I fully expect crude oil to gravitate towards 70. 70 has been the absolute high value price for 20 years. So it's basically the apex of the bell curve, and then do a normal rotation back down towards 40. Why is that not profound? Because the average cost of production in the world's largest producer is $55 a barrel. That's the U.S. We can produce more with less. We have a major surplus with Canada approaching in 2 years. If prices don't go down, that's going to approach 10 million barrels a day of crude oil and liquid fuels. In 2008, it was a deficit of the opposite. See where cycles are going? OPEC matters, but the rest of the world's having a major problem. And also, and I think the key thing to end with is what's happening in China. They're curtailing demand. Probably why? Because what do we know? Almost 60% of sales in automobile sales are EVs in 2022. Before the Russians' invasion of Ukraine, that was closer to 10%. See the shift?
Yeah. And, we could talk about that. I want to we're at 17 minutes, but this is why I could talk to you for so many hours, Mike, is because I'm not even done with the oil story yet. Because when you say power shifted, do you mean OPEC, the financial markets can now set the price more than the production quotas do? And secondly, I mean, at $70 oil, who's forced to respond first? Is it U.S. shale producers or are these OPEC members defending their budgets?
Well, all the above. So that's the key thing. It's not one or the other. First of all, markets are much more financialized. Let's go there right now. If you're bullish crude oil, or if you're bullish copper, or even broad metals, most commodities, you have to have the stock market go up, unless there's some kind of oil shock. It's just the way things are. We're so correlated now. Like I might have, mentioned earlier, the 60-day correlation between the Bloomberg All Metals Index and the S&P 500 is almost the highest in that index history, and it's only been around 30 years. So then let's look over supply and demand. I'll give you one example. Price maker status in U.S. soy and soybeans has shifted from the U.S. to Brazil. They're approaching 50% more than the U.S. production. 10 years ago, it was the same production. That's the incremental supplier. Price maker status from oil has shifted away from OPEC towards the Western Hemisphere to the U.S., formerly the largest demand pool, and now a major exporter and pushing almost the same amount of exports that China was importing last year before the invasion of Iran. So that's the shift financially and fundamentally. And the bottom line is my EV is 12 years old.
Yeah. Okay, well, let's talk about refined products because they're showing more weakness too. I mean, gasoline down nearly 2.5%, heating down full 3%, both falling faster than crude itself. I mean, here's what makes that remarkable. Russia just extended, I saw this morning, just extended its diesel and gasoline export bans into 2027. So, I mean, that's a natural restriction on exactly those products. They fell anyway, harder than crude. So is demand weakness showing up first in the products consumers actually use?
Now, I understand demand weakness. It hasn't been showing up too much. You're seeing it in consumer data, but it will. Yeah. The key thing is there's different markets now, distillates and underlying crude oil. So crude oil, I'm much more bearish on than distillates. But the key theme, though, for distillates, and most notably, the number one that matters from an election standpoint, and there's an election in November, and we have a very political president, is gasoline. That U.S. gasoline price at $4.11. That was my key trigger, Jeremy, in 2008, when it pumped up to $4 to just sell more, short the stock market, and buy more treasury bonds. Now, so far that hasn't worked this year. We're right about the same price as the peak in 2008, which shows you how blessed we are in this country with prices. But it's autocorrelation. That to me is going to be the key one. And if the best way to really hurt consumer sentiment is have gasoline go up and stocks go down. Now, so far stocks are doing well, but that's a key thing. The cracks are very wide. There's major incentive to produce, a lot of incentive to export. But what's the incentive we get towards elections? You got to get prices lower in this country. And it's just a question of how Mr. Trump's going to figure out how to do that.
To your point, Mike, I just saw it come over your terminal, actually, and BP is cutting 700 jobs while warning about oil oversupply in the middle of a war disrupting the oil's most important shipping route. So is that the clearest kind of corporate evidence yet for your $70 call?
Well, add to that, VW is cutting employees. BMW just announced layoffs. Why? Because they're facing major headwinds from the significant paradigm shift of rapidly advancing technology from China. Just the fact that we have 100% tariffs on these awesome EVs coming out of China is a good reason there's a problem globally. I mean, the rest of the world who doesn't, not like Japan or Germany or the U.S., who doesn't, and not major manufacturers of automobiles, say, thank you very much. We'll take those. And by the way, they're so much more cost effective, and just give those 10 years. I mean, where's that going? I own an EV. It's just amazing how much cheaper they are to run. There's only 500 moving parts, but that's the paradigm shift that I think is going to continue. And it's not just automobiles, it's renewables. And when you get prices spikes like this, it just incentivizes human invention. I think that's what's happening. And that's why it's just hard to stay bullish broad commodities, except for metals. The problem is metals probably just peaked too.
I got to ask you, before we go to metals, I mean, there's a piece that most people are skipping here, and it's on the demand side. I mean, China grew 4.3% last quarter, below Beijing's own target. The Politburo met and passed, I guess, a major new stimulus. Their 10-year yield is down towards 1.7%. So, I mean, that's the bond market pricing weakness, not recovery. Is China, a quiet reason your deflation call works? If demand from the world's biggest crude importer was weakening, I mean, how long can that war premium really hold, right?
So in full, yes, I've been pointing that one out a little too long. It hasn't worked yet, but that China 10-year note right now about 1.7% versus the U.S. 10-year note almost 300 basis points higher. Second largest economy in the world. Their debt to GDP is running 300%. Their money supply is running almost 2 times the U.S., yet there's 10-year note. It's a severe deflationary force. We've seen this before in Japan. Now, Japan's starting to come out of that. Yeah. But this, to me, is the number one factor I think since matter by the end of the year. And we just had a great test. Had this major, most significant disruption of energy flows in the world. And crude oil's running right about where it was in 2007. Why is that? What happened? We saw what happened in China. They were importing 11 million barrels or 11 to 12 million barrels for about 4 to 5 years. And last year didn't make so much sense to me. But now it does. Clear evidence they were topping off their SPR, Strategic Petroleum Reserves, and people like Louis Vincent Gabb said it might be 1.8 billion barrels. That's like, what, 5 times the US or maybe more than that? And it makes sense. But now it's just accelerating. They have a better use case for all their massive supply of renewables and EVs and accelerate that process of shifting to, non-petroleum consumption versus what they have they have a deficit of versus a surplus of their technology.
Now, I want to talk a little bit about the bonds. Obviously, that's making headlines today, but I don't want it to become, a pure rates conversation. We'll land on commodities at the end for the audience, but let's get to the part of kind of your work that's being tested. I mean, your argument has been that Treasury bonds are taking the safe haven job kind of back from gold, right? And that a Fed serious about inflation could end a 6-year run of gold beating on bonds. Then look what just happened. I mean, sold off stocks yesterday. The Fed held. Risk assets were kind of under pressure across the board. Investors dumped the 30-year, pushing its yield back to that 19 high. Inflation expectations went up, not down. You're talking about the market here, but I mean, it is the most since November of 2024. The long bond didn't behave like a safe haven on the day that it should have tested your thesis. What has to change for that call to work?
The number one thing for my call that has been wrong for almost 3 years now, and bond yields to be the next big trade. That's my main call for this year. Yeah. Is the stock market has to go down. So I look at that long bond as we speak 5.21%. That's a huge headwind for any non-income producing asset, starting from Bitcoin to gold. There's no reason. I mean, you got to have some major inflationary forces to make those viable versus a 5% long bond in a U.S. Treasuries. But the bottom line is the number one source for inflation is the U.S. stock market. It's still up almost 10% on the year. That's if it drops 10%, that's 25% of GDP, the most on a year basis since 2008. So I look at Treasury bonds right now as basically a put on the stock market with positive carry and no time decay. Puts, as you know, in my experience trading puts, I oftentimes will be right on the market. My puts will expire before I get a chance to be right because I'll be wrong first. But to me, that's the way they are right now. And the bottom line is this second half of the year will be the major determinant. I'm looking at it, it's going to be either a ho-hum year, stocks going up, which means you're probably not going to make much more in Treasury bonds. If the stocks drop, that 5.2%, I think is going to drop towards 4% in a heartbeat. And if stocks stay down, it's a major cycle kicking in, very similar to what we had in 2007.
That correlation's crazy, huh?
Yeah, so that's the key thing I want to point out too, is I love when people point out is the unstoppable deficit spending. It's not just in the U.S. You see it picking up in the rest of the world, and most of we have it very high in China, and it's picking up in Germany and Europe because of defense spending. But I like to point out, total U.S. debt in this country is between $39 and $40 trillion. Sure, that's unstoppable. I get it. But U.S. stock market cap is over $80 trillion. That's 2 times. It's the highest since 2007. U.S. debt in this country, that liability is minuscule versus that top asset that's real time, the stock market, at 2 times that. That's the last time we had bond yields at these levels. So I'm still very comfortable with that call. It's on the back of selling gold and selling Bitcoin at really stupid levels that just got too expensive and hiding out in Treasuries. So that's still my main theme for this year. That part's been wrong. They haven't lost a lot, but that's where I think this next second half is going to matter, Jeremy. If we start trickling down in the stock market, particularly later in the year you do it, that'll accelerate the trend could be certainly for a couple of years, but certainly next year. And that's what I'm thinking. You always look at iterations. Okay, if this and that. So if stocks stay strong, okay, fine. Fed might have to tighten, or kind of a ho-hum, boring market. But if we start ticking down the stock market, what's normal in this type of cycle, that's a big trade. And Treasuries will be the place to start. And that's what I think we're seeing warnings from things like Bitcoin going down and gold failing, and even the Kospi rolling over. It's only July. And we even got through August yet. Just wait till we get through closer to the midterms. This is going to be a fun quarter. And so bottom line, I'll end with this. I think it's going to be a trading year of a lifetime. Maybe similar to 2008. It's just getting started. And some of the key themes have already happened. Bitcoin's broken down. Silver's broken down. Gold's broken down after key rallies. And then 2 main things I've gotten wrong so far is copper. I didn't think it'd stay much above $6 a pound. And I didn't think that bond yield will stay much above $5, 5%. So far, we'll see how this works out towards the end of the year.
I was going to ask you, take it back to the commodity complex for me, because if the long end stays up here, what does that actually do? Producers obviously borrow to drill and to build mines, so financing gets more expensive. But which commodity kind of feels a 5% 30-year first?
Oh, you start with the gold, because gold is the most sensitive to its alternative treasuries. And that's why I like to compare. There's another measure on the terminal. We have a bond, a long treasury bond index. We go back to 1973 with that. If you divide that by gold, bonds are the cheapest versus gold since about 1985. That's the price. Like, okay, well, I'll look at that. And also we hear, everybody knows the fundamentals. Central banks buying, the World Gold Council just had the report today. I get it. We all know stuff we wrote about 5 years ago when I was really bullish gold to break above 2,000, which took about 3 years. So I was wrong on that one. That was the pain, and you got the gain. But then we got to such extreme levels. Gold in Q1 reached its highest ever versus the Bloomberg Commodity Index. Now that data we go back to clearly since 1975 when futures started trading, gold futures. That was a bit of an extreme. It got to silver, and silver got to its highest ever versus copper and crude oil. Okay, that was a bit extreme. And now we're in the hangover. And the key question is typically when you get this stretched and versus your own moving averages. But the thing also, last year's rally in gold, Jeremy, was so profound. I got lucky in that one, but so scary to me because we have never rallied at such high velocity, the best year since 1979, in a disinflationary environment. PPI, CPI peaked there, what was it, 15%, 13% or so in 1980? And gold ran, and now it's running 3.5%. To me, that was gold warning us, and there's one game left in the stock market. It's the only game left in town. And when that rolls over eventually, if it happens by the end of this year, that's a big trade kicking in. I think gold's winning. And that's the problem now, though. Gold's 60-day correlation to the S&P 500 is the highest ever in an up market for S&P 500. It's telling you if stocks go down, everything's falling because gold might drop a little less. The problem is it trades currently 2 times the volatility S&P 500. That's an annual basis, and typically a store value trading 2 times the value of beta is an oxymoron.
What do you think? I mean, when you see a day like yesterday, I mean, we started the day before the Fed down, ended the day up. It was a little bit iffy there, but look at the tape today. Gold's reclaimed that 4,100, traded as high as 4,122. Silver's up 2%. Platinum approaching 3%. Palladium up roughly 4%. I mean, that is a broad strength across the precious metals complex. What would gold need to do from here to kind of convince you this is more than a temporary rebound?
I don't know, but we have to be very careful about day trading in quiet markets in July, even August, and making much ado about nothing. This is the next trader. I just remember sometimes you have to step back. Yeah, let the traders knock it around. I used to be one of those. I used to have hair. But maybe gold can get lucky enough to stay above its 200-day moving average around $4, 4,400, 4,500. It might, Mike. But it looks to me very much, the whole industrial precious metals complex looks very much like cryptos did last year. And I really enjoyed jumping on the gold horse and getting off cryptos. Yeah, I was early, but pointing out gold. Precious metals are basically a couple doves. There's really 4: gold, silver, platinum, palladium. And gold is beta for the whole metal sector, which is only really 10 that matter. And then there's Bitcoin and cryptos. There's millions of those, and Bitcoin's beta, but there's an unlimited supply. They're like a bunch of pigeons. But they're all rolling over. They all were alternatives, and they all face one key thing. First of all, competition from 5% in the long bond and treasuries, and the Fed potentially, and 4% in the 2-year note. And they just went up too much. So to me, those are enduring bear markets are getting started. Gold's 200-day mover is just starting to roll over. Cryptos are clearing a bear market, but the most significant rallies happen in bear markets. They have to rip your face off. And that's why I like to just sit back and say, right now I'm still bearish gold. I'll probably put out a really bearish comment if we get to near the 200-day moving average and give us a bounce. But here's the way I look at the way these markets usually work. Typically, almost always, when you rally at this velocity, particularly in silver, it shifts what we're deficits into surpluses. People always forget that. Remember, supply, demand, and price. It's all the same model. Price just moved exponentially. And you put in peaks that last for decades. I think that's already happened in cryptos. I think it's already happened in precious metals. And the next key one is copper. That's where everything for me in Q. If copper goes down, that's the dominoes tumbling, because copper is the most highly correlated commodity to the S&P 500.
Has anything, what surprised you the most here? I mean, obviously during Wednesday's sell-off, just yesterday, I mean, gold, silver kind of rallied while equities were falling apart. I mean, that was kind of like gold acting like a safe haven. Did that surprise you?
No, gold has been hovering at $4,000 an ounce for how long? A couple months now. 4,100 is nothing. Like I said, it's got to get at least above 4,500 just to show potential. It's not a bear market. And then what's that going to do? Is going to bring in more sellers. The thing that surprised me the most was the spike in bond yields. Obviously, because that's my bias that yields are eventually going to go down. Wrong so far, but that's the key thing lesson you learn about markets. Sometimes you have to take the most pain for the most gain. Gold was my great example. I mean, I was bullish gold in the year 2020, 21, 22, and 23. And finally, at the beginning of 24, I quoted Roger Babson, who from 1929, I quoted the opposite what he says. I will tell you what I told you last year and the year before. The stock market's going down. So I just quoted him. I will tell you what I told you for the last 3 years. Gold's going up. Got that trade and got right. But it did it. It's done. That's the hardest thing in the market to point out is when you move exponentially like this and people say you're technical. I'm like, no. Supply, demand, price. When price moves that much, it shifts supply and demand with a lag. And that's where I think we'd be lucky. So I think what I fully expect, though, is gold should make it difficult, shouldn't make it easy. I mean, if it goes back to $3,000 an ounce before it goes to $5,000, that would be ideal, might give you a good chance to buy it. If something shifts exponentially, that gives me a chance, a signal to be bullish gold. The problem is right now at a 4-decade high versus treasuries, that would be, I can't get really bullish unless somebody gives a, something like a backup. But if it goes back to 5,000 first, I might have to put out a short signal like I did some of that in silver and I did some of that in Bitcoin. Gold's just hard to signal short because it used to be a store of value, but right now its status is a highly volatile speculative risk asset trading at 2 times the volatility of the stock market.
Let's do the rest of your world just for a second here, Mike. I mean, because you cover the whole complex and most interviews never leave gold, but wheat is up more than 2%. You talked about corn, a little bit about soybeans, cotton up, while the energy group is red. And I'm curious, where is kind of the most mispriced thing on your board today? Not the biggest story, but the most mispriced.
Natural gas. Mispriced as far as the one commodity I think is worthy of exploring purchases. Yeah. January natural gas peaked at 565 when in March after the U.S. Attack on Iran and after the coldest winter in 2 years, right? 10 years, but the second coldest winter. Right now, it just got to near 4. So I look at this, okay, that's an opportunity. And markets have to swing. They have to make it difficult. So as a trader, you look to be responsive. Okay, 5 was a bit expensive. 4 in January natural gas. And Jan matters because it's the apex of the bell curve. It's the highest price ever. That's when heating demands the most. It's back down to near 4. 4 has been a major pivot forever. I fully expect that to pop up near 5. To stay below 4, you basically need a warmer than normal winter, warmer than price in, and you need no weather scare. So to me, that's a bit mispriced there. The main thing I think is mispriced is long bonds at 5.2%. I think by the end of the year, they'll be much lower. Obviously, the biggest issue is the stock market. But in terms of commodities, I'm glad you went to grains because this week I had the honor of attending the AgriNext conference put on by Noble in St. Louis, Missouri. It was 95 degrees in midday there. In Miami, it's only 90. It was pretty steamy up there. But one sense I really love presenting and pointing out the price of this soybean you see on the screen right now. So wheat's pumped up for more political reasons. First of all, we had a bit of a drought for winter wheat in this, harvest in the spring in this country. But, we see missiles knocking at some of the wheat supply out of Russia and Ukraine. That's a bit of a pump thing for wheat. It's up 30%, but that's going to bring in more supply. The number one that matters right now is soybeans. Soybeans are about 40% of the Bloomberg Agriculture Index because you have soybean meal, soybean oil, and soybeans, actual soybeans, and they're running around $12. Why is $12 important? That was first traded in 1993. So I enjoyed pointing that out at the conference. That was a great grain robbery. If you look at crude oil, which popped up, remember we had the first Arab oil embargo, popped up to 10. It's up about, it got to 120 this year. It's up about 10 times since then, but soybeans is stuck there. And why is that? It's a highly autocorrelated commodity. Yes, we need food. It's used for everything. But there's massive supply coming out of Brazil, and the average cost of production in Brazil and the U.S. is lower than current prices now. That means just keep planting until prices go down. Unless there's a bad weather event, which would be a short-term thing, prices are going to go down. So that's one of my main calls right now is natural gas at 4 is probably going to go up, and soybeans that just got near 12 is probably going to go down. You basically need, for soybeans to go up now, you basically need crude oil has to probably stay above 100, and you probably need a really bad flash drought in August in Corn Belt.
All right. I got to talk currencies just for a second because there's something on the screen this morning I think it's worth putting to you because it may reframe the whole conversation. I mean, gold is up better than 1% in U.S. dollars, but price in Japanese yen, it's down more than 1.5%. In euros and pounds, up a fraction. So for American, gold's rallying, but for Sabre in Tokyo, it's falling. I mean, it is what we're calling, a gold rally actually just a dollar decline.
Well, certainly in Japan right now. The thing I get from my colleague, and it's one thing I've been an advantage at Bloomberg. I have all my colleagues who cover like currencies. Audrey Child Freeman covers currencies out of London. She's been pointed out, yeah, Japanese yen is great, but the speculator positions long the dollar, short the yen are very extreme. You got to get a flush out of that, and that's what I think we're doing right now. But the fundamentals I still look at are just what's so great about the fundamentals for Japan. Declining economy, they're a major export economy, and whether they're still exporting mostly internal combustion engines. And by the way, you look over at China and their vehicles are much better and cheaper. I mean, the overall demographics of Japan are just horrible. In the macro big picture, everybody gets it. They're trying to think that maybe they're getting a little recovery, inflation. I'm like, good luck with that. When the stock market goes down, you're going to see what's going to happen in Japan. To me, that's why we have to get through this big test.
Right.
So I'm tilting over to some quasi currencies like cryptos. Cryptos have already flunked that test. And the test is, how will markets react when we have the first 10 to 20% correction in the US stock market that stays down for a year or so? It just stays down a while. Stuff that used to happen, that's way overdue. All the signals are there, and Bitcoin's already flunked the test. And it didn't even come. Now, some of the currencies I don't know, but the key thing I'm also concerned about the macro of the dollar that one of my former colleagues, Gina Martin Adams, taught me is the dollar has basically been tracking dollar versus the basket of currencies, the US stock market versus the rest of the world since 2009, straight up. So what happens if stocks go down? So that's why I'm kind of concerned. But the bottom line is it hasn't really mattered. I look at the Dixie, it's like near 100, same price as a decade ago.
But I have to ask you on Japan, because this morning there was some interesting, obviously, because it goes to your bond call too. I mean, the yen just jumped about 2% against the dollar, biggest move since the spring. There's speculation. Japanese officials stepped in again. That currency had slid into its weakest in 4 decades. And when Japan intervened this spring, it spent a record amount, north of $70 billion. And reporting suggests it funded part of that by selling foreign securities, obviously T-bills, U.S. Treasuries. So if that's happening again, one of the largest foreign holders of treasuries would be selling them to defend its own currency. At the same time, the 30-year is at, that 19-year high. Is that part of why the long end won't rally? And does your bond call get harder if Japan is again selling those treasuries to defend the yen?
Oh, it's one of my favorite reasons to buy treasuries since I started in the business in 1988, Jeremy. I've heard it so much. So many times I've heard, oh, foreigners are going to sell the treasuries, yields are going to go up. Or there's too much supply, yields are going to go up. And every time I've heard that, they've basically been wrong. And it's just the way it works is, okay, so what are you going to buy? You can, in Japan, you get 2.79 in the 10-year note. In the US, you get 4.7 on your 10-year note. It's just, they're, and how deep is their market versus the US? There's not any even close. But the bottom line also for all this, the 10 for all yields on a global basis, we've seen the pickup a little bit, but in China, 1.7% is what the U.S. is the next move for the U.S. stock market. So I think yields will go down in the U.S. when the U.S. stock market goes down, and yields will stay sticky if the stock market stays sticky. Yeah. Guess who gets that? 2 key people I know. I know Besson gets it because he's an ex-trader, and I think Warsh and him probably very much understand that. They just can't say it. But as a trader, as an ex-trader, I look at things they say, I'm like, yeah, okay. I still think long bonds will be probably the best trade for this second half of the year. And guess what? I've been wrong on that one for a couple of years.
Yeah. I mean, but they're sitting here pretty high today. And we can kind of look at gold the way you actually look at it too, relative to other things, not in dollars. I mean, you've written that gold faces normalization again against broader commodities. You kind of talked about it here, Mike. I mean, put that plainly for people, though. Is the argument that gold isn't expensive against the dollar? It's expensive against copper, against gold, against the rest of the complex?
It is expensive against its major competitors, that's U.S. Treasuries. Yeah. Like I said, at least a 4-decade high. I can use a basket of Treasuries. I can use just a measure of the U.S. long bond. So that's the key thing. It was expensive. In Q1, it was the most expensive ever versus the Bloomberg Commodity Index. Now, I go back 50 years on the data, and typically if you start with like a base of 1 in 100 in 1975, it's hovered around 100 forever, and it's popped up to 2.5. Now it's down. It's just... markets front run the narrative. And I love getting on your program, and I love going to metals conferences. And for the first time in 10 years, this year, I was pointing out bearish inklings. And I've been wrong on copper, but bearish inklings, most notably gold, and gold is baited for the space. Yeah. And people look like it may have 3 heads. Like, well, markets moved. Did you not see what happened? You have to adjust. The facts have changed. Now, the fundamentals are the same, but prices will dictate. And it's just the key thing is, I knew people that I hadn't spoke to for a decade back in Q1. I had spoke to, and it was so hard for them to disgorge the gold. themselves in gold because it got such, such a part of a more normal portfolio for people who are kind of concerned about stock market, but you're supposed to sell. The question is what happens now? And that's why I'm worried that we might get a lot more of these false rallies if we've been getting in cryptos for a year. And this suckers some people in. I don't think there'll be a time to buy gold until it gets relatively fair value versus at least the stock market and fair value versus a basket of U.S. Treasuries. And we're way too stretched right now.
All right. Mike, I got to ask you about the other metals quickly while I have you, because all we usually talk about is gold. But I mean, silver's up, 2%, platinum approaching 3%, palladium up roughly 4%. Which of the four is most vulnerable from here?
The devil's metal will live up to its reputation. I enjoyed Jeremy saying that on national TV a couple years ago when it was breaking out, and the anchor hadn't heard that term. But when you trade silver, you'll learn that one real early. Yeah. So I fully expect silver is going to get stupid cheap is stupid expensive is a god. 50 is kind of the key first level to kind of knock around. That's an old lows. It probably should bounce from there. 80 or so is pretty good resistance. I think it's going to knock around in a range for decades like it has in the past. Fundamentals, we all get it, but it's shifted. Prices just moved exponentially. We moved like the highest versus the greatest velocity versus a 60-month moving average since that peak in 1980. So to me, that's part of the problem. And then we look at broad metals. The key thing is, so here's one thing I want to point out is the Bloomberg All Metals Total Return Index. I asked our index team to create that index a decade ago. Why? Because the metals typically are the best place to invest in commodities from a total return standpoint. Low autocorrelation and low storage costs. You typically want to hold the metals, particularly gold. That's been one of the best performance. The only major sector that made a new high this year was precious metals and metals, and they pretty much put in a peak, unfortunately, the whole space. So that's why I narrowed down. It looks like gold, silver, platinum, palladium. They're pumped, and they dumped all of them. Iron ore has pumped, then dumped on the year. The number one thing for make them potentially recover is stock market probably has to go up. But what's next? The number one thing on the list that I'm watching like a hawk is copper. Now today, as we speak, copper is around $6.50 a pound. That's wonderful. But if you overlay copper, which I've watched versus S&P 500 forever versus the S&P 500 total return, it's a complete dud. And it started breaking down in 2023. So I think what copper's stuck is between inflation in the U.S., inflation and risk assets in stock market, and deflation in China as measured by that 10-year rate at 1.71. Which one wins? Let's see the test. So I think the way I look at copper is, great, it made a new high, but because the stock market led the way. If the stock market drops 10 to 20% and copper can show me some divergent strength, maybe I can get bullish, but I fully expect it to be more likely to head towards 5 than stay much above these levels, particularly if you get a normal correction in the stock market. That's the problem. My headline for last month's commodity outlook for industrial metals and metals were they're sock puppets to the U.S. stock market.
Yeah. Hey, I got to ask you something different before I let you go, because people forget there's a person behind these calls. I mean, you've spent a good chunk of your career making, the argument that makes you the least popular man in those rooms. You're bearish gold in front of gold audiences. You're, cautious on Bitcoin while it climbed for years. And I imagine the replies were a delight. What's that actually like? And how do you avoid the two traps, digging in out of stubbornness and caving because everyone's shouting at you?
Oh, you got to embrace it. It's a lesson I learned in the trading pits. I remember my job was to cover clients, and say if you had 7 clients and you come up with a great idea and you call them all up and they all agreed, you get the trade, and then you realize almost always you're wrong. When everybody called you an idiot, and maybe one guy did the trade and did it like in a small amount, like a 100 lot when he usually does 1,000 lots, you're usually right. It's just a lesson you really learn right away. But it's also the most significant thing is cryptos are the best for this because they're so emotional. And the signals I got from them when I was calling for Bitcoin to drop a zero from 100,000 just last year were just delightful. I mean, to be called Mick Retard is like, thank you, you emboldened me. And when I was talking how bullish I was in gold a year ago, the nickname I got was McGlone because I was bullish for other reasons. But it worked. But no, that has to, as a strategist, as a trader, as a position, as someone who's investing, when you sense this, the herd's leaning too much to the side of the boat, you got a position on and you've made money. Here's one lesson I'll point out that I've learned in markets is you always have to give something a little bit back to the market gods. If the market gods give you profits and you taunt them, you will learn the hard way. Michael Saylor made a great example of that in 2024. He's the head of strategy. He double dogged the Bitcoin market by doubling down on the 10x, and he made fun of Warren Buffett for not investing. And his stock MicroStrategy was about $400 at the time. Right now, it's 96.
96, huh? Give the audience, I guess, a little bit of a watch list, because a lot of people are going to be watching this over the weekend, at least later this week. 2 or 3 things to watch. What level on each? And if they only kind of remember one number from this whole conversation, what should it be?
$70 in crude oil. First of all, that's the normal high volume price for 20 years. Yeah. I think it's going to gravitate towards there. If it stays above 80, that's a bit of an issue. That means Republicans are probably getting hammered in elections. Mr. Trump has to do that. So to me, that's the key levels in crude oil. I think it's going to be mostly lower. So that's the one that matters. In gold, 4,000 is a lock-in. As far as key levels, can it stay above 4,500, which is around the 200-day moving average? It may bounce there. That might be see some responsive selling. Key supports around 3,500. Remember that lock-in last year? It's like the best signal I ever saw between like April and August, and it finally broke out higher. So those are the key levels there. And then to me, the bottom line for all markets, to what really matters, and I'm just keeping an eye on copper. If it can stay above 6 and 650, that's wonderful. But a normal reversion in copper with managed money net positions, almost 26-7% net long of open interest is CME, which is like 5 times the normal. Is just, if we get a little reversion in copper towards 5, that or just breaking down below 6, that's I think can be a sign of a problem in all markets.
Yeah,
and then of course the long bond. Can the long bond stay above 5%?
Hey, my favorite thing to ask anybody with a big call. I mean, what are you watching that could change your mind? Something in the next few months that has you saying, okay, I need to rethink this.
Number one thing for everything is U.S. stock market has to stay resilient. If that happens, it'll shift a lot of my views. But what happens if that does happen? Fed will have to be most likely focused more on tightening. But that's the number one thing that's going to matter. That's the number one determinant. If it stays resilient, it's oh-hum. If it drops, trade of a lifetime might be just getting started. Yeah. So that's what I look at as an option trader. It's great. Yes, just inching higher is like nothing to say. But if it breaks down, I've got a lot to write about.
Good advice. All right, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Obviously appreciate you coming on, laying out the case many in our audience may see differently, and that's exactly the conversation worth having here. So appreciate your time.
Thanks for having me.
All right, now I want to hear from you. 3 calls, $70 oil in the middle of a war, rate cuts instead of hikes, and gold's high is already behind us. Which one holds up? Which one breaks first? Tell me in the comments. We do read them. Subscribe, hit the bell. We do this every day. I'm Jeremy Szafron for all of us over here at Kitco News. Thanks for watching.